So our topic for this week is going to be uncertainty. And this is an important subject, not just in terms of the value and capital budgeting problems that we have been considering, but also for other areas of finance, such as investment, financing, portfolio optimization, risk management, and so on, right? So since this is an important topic, we are going to be spending quite a bit of time on it this week as well as next week. So our plan is to first actually think about the value and capital budgeting problems that we have been talking about and think about how uncertainty changes the things that we have been discussing. And then in the second part of this week, we are going to be looking a bit more deeper into the theory of how you make choices under uncertainty, right? So before we get into these things, let us recap a few terms that you might be familiar with from your previous courses on probability and statistics, which we'll be encountering quite often in this context. And we'll also be perhaps talking about a few terms that comes up under different names in the setting that we are talking about. So the first such concept is the notion of expected value. So as you are aware of, this just refers to the probability weighted average of all possible outcomes, right? So in concept, this is very similar to the notion of average or arithmetic mean. The only difference is that typically we use the word average when we are thinking about working with past outcomes, whereas expected value is used when we are thinking about working with future outcomes, right? So a classic example that is often used is that imagine that you are tossing a fair coin. So remember, the word fair here means that the probability of heads and probability of tails are same and are equal to half. And imagine that you are going to receive 100 units if head occurs or 200 units if tail occurs, right? So the expected value of winnings from such a coin toss would equal to half into 100. So half being the probability of heads plus half into 200, which is equal to 150 units, right? So this is also kind of related to the notion of random variable, which is basically a variable whose realization is not yet known. So in this coin tossing example, for instance, one could have actually defined a random variable, let's call it W, which is referring to your winnings. So this W takes a value 100 with probability 0.5 and a value 200 with probability 0.5. So what we calculated before when we said expected value, we were actually referring to the expected value of this random variable, right? So another point to note is that once the toss happens, this W is no longer a random variable in the sense that we actually know what is the value that your winning took, right? So then after the fact, this is no longer a random variable, right? So just to also kind of like be clear about the concepts, is for instance, the expected value of W a random variable here? The answer is no, because you already know the expected value even before the realization of the uncertainty, right? So therefore, it's not a random variable in this case. Another term that you might often hear about is something called the fair bet, right? So what is a fair bet? So this is a bet that costs its expected value, okay? What does that mean? So basically what we are saying is that a person who is offering the bet and the person who is taking the bet should actually expect to end up not making any money in expectation, right? So let's consider the following example. Imagine that there is a 1/4 chance of being paid 200, 1/4 chance of being paid 1000, and a half chance of being paid 800 if you take up a bet. What would this correspond to? So imagine that you have got two fair coins, right? And if both of them ends up being heads, you're going to be paid 200 by the person who has offered you the bet. If both of them ends up being paid tails, you're going to be paid 1000. And if one of them turns up to be heads and the other turns up to be tails, doesn't matter the order, you're going to be paid 800, right? So this is the bet that somebody has offered, right? And of course, this is not something that is being offered for free, right? So perhaps in order to play this game, you have to first give some money to the person who is offering you this bet, right? So now one question would be that suppose that you want this to be a fair bet, right? What would be the fair price for this bet, right? So in order to calculate the fair price for this bet, in order to be a fair bet, what we require is that your expected amount of winning from this playing this game has to be equal to 0, right? So how do you kind of like calculate the fair price? So based on the information that is given, you can calculate that if you do take up the bet, what's the amount of money that you expect to be paid? So you can do the calculation in the standard way. So it's equal to 1/4 times 200 plus 1/4 times 1000 plus half times 800. So this is equal to 700. So suppose that in order to play this game, you're asked to first initially pay an amount 700 to play this game, right? Then in that case, the expected amount of money that you expect to get is equal to 700 minus 700 or 0. And similarly, the person who is offering you this bet, that person also expects to get 0, right? So that therefore the fair price for this bet can be calculated in this following way, and it equals 700. Okay. So another term that we often kind of like would encounter here is standard deviation. This is again something that you are familiar with, but let us give it a more kind of like a finance application. So in finance, as you will see that we are often interested in calculating what's the reward from undertaking an investment, right? So there we often use the expected value of investment as a measure of the average reward that one would expect to get from making an investment, right? However, investments are typically not something that you can kind of like just get money for free. There's typically some risk associated with this investment as well. And we also need to think about how do you measure the second aspect of investment, right? Namely, the risk of the investment. So one way of thinking about risk, and there are many different ways of thinking about risk, is that you can think of risk as a measure of the variability of outcomes around the expected mean outcome, right? So if you think about it in this way, this is actually should remind you of this concept of standard deviation that you have seen, right? So let's go back to this example that we talked about, where you had the bet based on two tosses of the coin and the payoffs were as discussed before. So recall that we calculated the mean, that is 700. So what's the standard deviation of your amount of money that you are going to be paid if you do take up this game? So we can calculate it in the following way. So we'll look at each possible outcome. So the outcomes corresponds to you being paid 200, 1000 or 800. We'll look at the deviation of this amount of money that you expect to be paid from the mean. So in the first case, it would be 200 minus 700. In the second case, it will be 1000 minus 700. In the third case, it will be 800 minus 700. But because we do not want these things to cancel out, what we care about is the basically the squared value, right? So that you do not have the positive and the negative terms canceling out. So then we are looking at basically the means, the squared deviations. So the squared deviations in this case would correspond to 200 minus 700 squared, 1000 minus 700 squared, and 800 minus 700 squared, right? And then we are going to weight by the probabilities. So the probabilities in this case are 1/4, 1/4, and half each. So these are the terms that you have here. And finally, we are going to be taking the square root, right? We take the square root in order to have the same unit as the initial amount that we were talking about, right? So basically what you have is, this is a measure of root mean square deviation, which is exactly what standard deviation is, right? So if you do the calculations, this will turn out to be 300. So we are going to be using these things later on as well, but we just wanted to have a quick review of it in anticipation of things that you are going to see. Okay, so let's now look at an application to these concepts of this uncertainty that we have been talking about. So far, what we have been discussing in class are about loans where you know for certain that you are actually going to get paid whatever is being promised, right? However, in reality, most loans are not risk-free, right? Because you might have situations where the borrowers may not be in a position to fully repay back what they had promised to repay, right? So in this case, we are basically in a situation where the bonds are not safe, right? What we were talking about in terms of governments, but these are bonds which are risky bonds in the sense that they have risk of default attached with them, right? So one question is that how do you compute the appropriate rates of return when you have got bonds which are risk, right? So we are going to first start out by looking at a couple of examples. And in each of the examples, we are going to assume that the participants are risk neutral, right? So this is a term which we would formally define later. But for now, think of this as saying that the participants only care about the expected values, and they do not care, for instance, about the risk that is involved in the sense of risk being measured by standard deviations. Okay. Okay, so let's consider our first example. So we have got Amar, who is deciding whether to extend a loan to Bhaskar or not. So the terms of the loan that he's considering are that this is going to be a 1-year loan, and this amount of loan that he is going to give to Bhaskar is of worth 1 million units. Okay. So what are Amar's options? So Amar's option is that if he does not give this loan to Bhaskar, he has the option of actually investing this 1 million amount of money that he has into government bonds as well. And let's assume that the government bonds are safe in the sense that there is no chance of default, and they offer an annual rate of return of 10%, right? So the question that Amar is thinking is, what's the interest rate that he should charge Bhaskar, right? That's the question that we want to answer. So the answer actually depends on what Amar thinks is the probability of Bhaskar actually being able to fully repay the loan. Okay. So suppose first that Amar is 100% certain that Bhaskar will be able to fully repay the loan. Okay. Then in this case, what Amar should do is actually charge Bhaskar 10%, right? Because if he does that, then he's going to get the same rate of return as he would have got if he had actually kind of like invested in government bonds, right? And so therefore, both of them, both of the investments, if he had given the money to Bhaskar or if he had invested in government bonds, would actually end up resulting in 1.1 million units being returned after 1 year, right? So that corresponds to the 1 million in terms of the loan that is given and the 10% interest, right? But now let's actually complicate the situation a bit, right? Suppose that now Amar thinks that there is only a 50% chance that Bhaskar will fully repay the loan along with the interest that he's asking. Okay. By the way, some technical terms here. So if we have a situation where the borrower is able to fully repay the loan, right? And this would typically correspond to the case where the borrower's assets exceeds the borrower's liabilities, then this situation will be the one where the borrower is basically solvent, right? So if the borrower is solvent, then the borrower is able to pay back the loan and the interest. Okay. The other situation is one where the borrower is not able to fully repay back the amount borrowed plus the interest, right? And we will refer to this situation as the one where Bhaskar is going to default, right? So in this situation, basically we are looking at a case where there's only a 50% chance that Bhaskar is going to fully repay the loan along with the interest. And in the other 50% case, Bhaskar is going to default, right? Now, let's suppose that if Bhaskar defaults, then he's only able to repay 750,000 back. Remember, the loan taken was 1 million. Presumably, there's some interest rate on top of that. But in the situation where Bhaskar is defaulting, let's imagine that he's only able to repay back 750,000. Okay. Now, let's consider what are the options that are open to Amar, right? So suppose that Amar continues to charge Bhaskar the interest rate of 10%, right? Remember, this is the interest rate that Amar would have charged to Bhaskar if he was 100% certain that Bhaskar will repay the loan. And this would have resulted in him getting back 1.1 million units if it is 100% sure that he is going to repay the loan, right? But now we are dealing with a situation where there's only a 50% chance that he will repay, right? So in this case, if there's only a 50% chance that he is going to repay back the loan, then with 50% chance, Amar is going to get back 1.1 million, right? But with the remaining 50%, Amar is only going to pay back, get back what Bhaskar can pay, which is 750,000, right? So now if we calculate the expected amount of money that Amar expects to get back based on these numbers, we can see that this corresponds to only 925,000, right? So in this case, the expected rate of return can be calculated as the expected return divided by the initial money that was given, which is 1 million minus 1, right? So same calculation as we had done before in terms of rate of return, except that here we are in the numerator, we are putting in the expected return, right? Rather than the actual the return. So now if you do the calculation, this corresponds to minus 7.5%, right? So definitely, if this is the rate that Amar is charging, 10%, right? Then Amar's expected rate of return, if he gives the money to Bhaskar, is minus 7.5%. Versus if he had given the money into the government and by purchasing government bonds, he would have got 10%. And if he cares only about the expected rate of returns, which is the case, remember, we are assuming people are risk neutral, then definitely Amar would have been strictly better off by actually giving the money to the government, right? So 10% does not actually make sense in this kind of a risky situation, right? So if 10% does not make sense, basically the lesson that you have learned so far is that Amar should ask for a higher interest rate from risky borrowers, right? But what does a higher interest rate mean here, right? What it basically means is that he should ask for a higher promised interest, right? Which corresponds to the amount that he is getting in the good times. That is the times when Bhaskar is able to repay back the money, right? Of course, if Bhaskar is going to default, then he's going to actually only pay back 750,000, right? Doesn't matter what you are asking, right? So the only control that Amar has in this situation is to specify that if you are able to repay back the money, which remember happens with probability 50% here, what is the amount of money that you should repay back, right? So suppose that first we want to kind of just figure out that, okay, we want to look for the case where Amar is just indifferent between giving money to Bhaskar versus putting in the money in government bonds, right? So what would be the case corresponding to? So the expected amount of money that Amar is going to get if he puts the money 1 million units into government bonds after 1 year, that is going to correspond to 1.1 million, right? This is the expected amount, but in fact, it's actually an amount which he's going to get for sure, right? Now, suppose that he asks Bhaskar to pay back X, right? And remember, this is with 50% chance, then Bhaskar will pay back X. Then the expected amount of money that Amar is going to get if he gives the money to Bhaskar is going to be equal to 50% into X plus 50% into 750,000, right? 750,000 corresponds to the case where Bhaskar is going to default. So now you can actually solve for this X, and you can show that in order for Amar to be indifferent between extending money to Bhaskar or to put money in the in purchasing government bonds, the X value of X should be 1.45 million, right? So if you now calculate the interest rate corresponding to this amount, 1.45 million, you can show that this is equal to basically 45%, right? So this is basically the promised interest rate that Amar needs from Bhaskar in order for him to be indifferent between giving Bhaskar the money versus putting in the money in his alternative option, right? Okay, so let's just kind of like acquaint ourselves with some technical terms. So this 45% promised interest rate that we calculated, we can break it up into two parts, right? You have got here 10%, right? This is the basically the interest that he would have got if he had put in the money in the government bonds. So this actually is known as the time premium, right? So this is the amount corresponding to what the government bond pays. And the difference between this 45% promised interest rate and the 10% time premium, which is equal to 35%, this is what is known as the default premium, right? So what is the default premium? The default premium is the difference between the promised rate, 45%, minus the expected rate that the lender would have to demand to break even, right? That is the rate to earn the same one as he would have done if he had invested in government bonds, okay? Note, this is an important point. The default premium is not extra compensation from taking on risk, right? Basically, we'll come back to this later, but the extra compensation for taking on risk would have corresponded to something that you are basically would have asked for because you are risk averse, right? But here we are not brought in risk aversion, so we are just dealing with risk neutral people, right? So that is not something that that an extra amount that you're asking just because you are taking on the risk, right? Okay. One thing to keep in mind is that whenever you see the interest rates that are being quoted in newspapers and financial documents, keep in mind that those are actually basically quoting the promised interest rate, right? Basically this 45%, right? And not the expected rate of returns, which is basically what you would actually want in order to, for example, do calculations related to whether you should take up the project or not, right? And this default premium also goes by the name of credit premium. And the default risk is often called the credit risk, right? So again, if sometimes you will see these terms being used, so it's important to know what these terms mean as well. Okay, let's look at another example just to kind of like fix ideas. Imagine that you have got Aparna who is lending money to Jyoti, and Aparna believes that Jyoti will pay back whatever she promises with 98% probability will pay back half of what she has borrowed with 1% probability and will pay back nothing with 1% probability. Okay. Now, Jyoti wants to borrow 200 units, and Aparna has the option of extending these 200 units to Jyoti and also determining, how much should Jyoti pay back, right? But Aparna has also got this other alternative option of actually investing this 200 units in government bonds, which is offering a 5% interest rate. Okay. Imagine that all of the players, Aparna and Jyoti, are risk neutral in the sense that they only care about the expected values, right? The question is, what's the interest rate that Aparna should ask Jyoti? So we'll proceed in the same way that we have done before. So suppose that first Aparna asks Jyoti for a 5% interest. Remember, this 5% is basically the interest rate that the government bonds are offering. Then what will happen? So in this case, basically, this is the promised interest rate, right? So therefore, for 200 units, 5% would correspond to 10 units. So basically, Jyoti will pay back 210 units with 98% probability, right? We'll pay back 100 with probability 1%. So where we are getting this 100. So remember, Jyoti wants to borrow 200 units, and we have that Jyoti will pay back half of what she borrowed with 1% probability, right? So half of 200 is 100 with 1% probability, and pay back nothing with 1% probability, right? So in this case, if you think about what's the expected amount of money that Aparna would be getting back, we can do the calculation as 98% into 210 plus 1% into 100 plus 1% into 0. And this corresponds to 206.80, right? So this expected return of 206.80, this is definitely less than the 210 that she would have got if she had invested in government bonds, right? So basically, if Jyoti promises Aparna a rate of return of 5%, and this is where we get this 210, right? Then Aparna's expected rate of return is only going to be 3.40%, right? And the difference is coming in from the fact that this amount 5% is going to be repaid back only with probability 98%, and there are these other scenarios where Aparna is not going to get this rate of return of 5%, right? Okay, so then suppose that Jyoti wants Aparna to be indifferent between giving her the money versus investing in the government bonds. How much would she actually have to promise, right? So that Aparna's expected rate of return, if she gives money to Jyoti, also equals 5%, right? So in this case, if we want to solve for this, how much Jyoti needs to promise, we can actually solve it in terms of this equation, right? So if Aparna keeps the money in government bonds, then she's going to get 210, right, in return of that 200. And if she gives money to Jyoti, then with 98% probability, she's going to get back X. This is the amount that Jyoti is promising Aparna. With 1% probability, she's getting back 100. And with 1% probability, she's getting back 0. So now if you solve for it, you can find that if X is approximately equal to 213.27, then Aparna would expect to earn the same 5% return that she could have earned by investing in government bonds, right? So basically this 213.27 for a loan of 200, what is the corresponding interest rate that comes up? So that's equal to a promised interest rate of 6.63%, right? And a promised interest rate of 6.63% actually ends up leading to a expected interest rate of 5%, right? Just to make sure how are we getting this calculation. So we have got that with probability 98%, there's going to be a return of 6.63%. With probability 1%, there's going to be a return of minus 50%, right? So minus 50% in the sense that an investment of 200 leads to a return of only 100, right? So that corresponds to a minus 50% rate of return. And 1% probability there's going to be a rate of return of minus 100%, right? So all the investment is lost, right? And now if you calculate this, this corresponds to a 5% expected rate of return. Okay, so you have got this promised interest rate, which is 6.63%, and you have got the expected interest rate of 5%, right? Which is the amount of money that you would get if you are putting in the money in the government bonds. So this difference, which is 1.63%, is the default premium, right? Remember, this is what we had discussed before. And this is the extra interest rate that is caused by the default risk that you're going to demand even if you are a person who is risk neutral, right? So again, it's important to keep in mind that the promised rate of return and the expected rate of return are not the same things. And typically the number that you are going to be seeing quoted in all the kind of like documents related to financial securities, all the information that is provided is almost always this quoted rate of return or the promised rate of return, which is going to be higher than the expected rate of return, right? Now, in perfect markets with risk neutral investors, the promised interest rate, which here was 6.63%, is going to equal the sum of the term premium, which is the 5%, and the default premium, 1.63%, right? We also know that if you have got perfect risk neutral world, then all securities should have the same expected rate of return. So what that means is that on average, under risk neutrality, the expected rate of return is the expected term premium plus the expected realized default premium, right? And so therefore, what's the expected realized default premium? That should on average equal to 0. So let's see how that works out in this case. So remember that Aparna is going to receive this 6.363% minus 5%, or 1.63% with probability 98%, right? So in terms of the default premium, minus 50% minus 5%, which is minus 55% with probability 1%, and minus 105% with probability 1%. Why are we kind of like talking about this negative of 5% in all the three cases? This is basically corresponding to losing the term premium, right? If you are giving the money to basically somebody else, you're not putting the money in terms of getting the government bond interest rate, right? So therefore, what's the expected default premium? Remember, these are basically the realizations of the default premium. These are the probabilities. So we can calculate what's the expected default premium. So that would correspond to, with 98%, it's the default premium is 1.63%. This is the realized value. With 1%, this is going to correspond to minus 55%. And again, with 1%, it's corresponding to minus 105%. And so therefore, now if you do the calculation, this is going to be 0%. Okay. So just some other things to keep in mind. So we have already talked about this term premium and the default premium. There are some other premiums that you might often hear about. So for example, you have something called the risk premium, and this would basically be about, if you are willing to take on risk, and in the real world, you have got people who not only care about the expected value, but they care about the risk associated with investments, then they need to be compensated by even higher interest rates, right? And you might often have something called imperfect market premiums. For example, this would be liquidity premium would be an example of such a type of thing. And this would mean that you need additional compensation for instance, for having difficulty in finding buyers for the bonds, right? So all of these actually kind of like would lead to even more higher interest rate being charged. But for now, we are abstracting away from all of these things. We are in a risk neutral world. So therefore, you do not have this risk premium. And we are in a perfect market world. So you do not have this expected, this imperfect market premium to worry about. But we'll discuss these things later on once we bring in discussions of, for instance, risk aversion, as well as discussions of imperfect market. So that's coming up in future lectures.